Hi, this is Daniel, and you're watching Unrivaled Investing, a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. Just earlier today, Greg Jensen, the co chief investment officer of Bridgewater, the behemoth, one of the largest hedge funds in the world, managing tens of billions of dollars, gave an interview at Bloomberg, and he revealed effectively Bridgewater's playbook, how they're investing right now, to understand, okay, these are the bets we're making and this is the reason why we're doing it. I want to do a video that sort of peels it back a little bit so that way you can understand why Bridgewater is positioned the way they are and how it could potentially affect your investment portfolio, how you should think about growth stocks, let's say, versus the consumer staples, because there's a real sort of divergence going on right now and how investors should consider it. Let me dive right into it. Where here it is, Greg Jensen, co-chief investment officer, had an interview on Bloomberg. I'll leave the link for that below. So revealing their playbook in the interview. And to understand the current setup, as he discusses in the interview, you need to understand a couple of things. And this is sort of understanding the top-down perspective, which is one, the Fed and fiscal policy is driving the markets right now. That really shouldn't come as a surprise. We have extreme Fed and fiscal policies, really, really low interest rates, and incredible deficits. That is what's driving a strong economy, very high GDP growth, or at least tied to nominal GDP growth, and very low interest rates. Treasury yields across the board below 2%. But the problem with this is you can't do it for too long. It's sort of like giving a sickly patient just crazy amounts of steroids or heavy duty medications, where longer term you should expect some negative consequences. So he starts saying, like, look, there are generally three negative consequences that the Federal Reserve has to be mindful of. Eventually the Federal Reserve has to respond, where the three main things are inflation, bubbles, and you're starting to see both of these things. Inflation over 5% this year. Bubbles, I mean, you're talking about NFTs of pictures, the JPEGs of rocks, digital rocks, going for hundreds of thousands of dollars. And you're seeing currency risks eventually, where effectively you have a devaluation of a currency because folks say, well, wait a second, why do I own this if I'm at negative real yields? So then he, sort of posed with the question of, like, well, okay, so what are investors supposed to do if, let's say, you're buying stocks? What's the bigger risk? Is it a cyclical downturn, or is it more that it's monetary tightening because of these conditions of, let's say, higher inflation, or effectively a weaker U.S. dollar, and need to consider that? So how are they playing it? And what's interesting is you look at their most recent, financial update in terms of their own portfolio, and effectively they're just layering into these cash cows. Greg Jensen has effectively said, look, the world is over-owned, the U.S. indices. And so that's why you see them trimming their S&P. They're making more bets effectively on emerging market ETFs. But the US stocks that they are owning are these incredible cash cows. It's just companies that have a ton of free cash flow. And so that means their valuation is going to be backed up by a cash yield. So effectively you're getting a couple percent return as a minimum because that cash is coming in, whether or not it's a Walmart, Procter & Gamble, Johnson & Johnson, Coca-Cola, Pepsi, Costco, McDonald's, Alibaba. Full disclosure, I own Alibaba stock, as I've talked about before. And so this is a really interesting perspective. Like, wait a second, this is a consumer staples bet. Now, why is it that you would want to own potentially consumer staples in this environment versus, let's say, growth stocks? And it is worth calling out that a lot of the more growth-oriented portfolios have really struggled so far this year. I think several of the Cathie Wood ARK portfolios, they're either down or just flat for the year. And so it's sort of a question of, like, well, what's going on here? What's sort of this phase transition that you're seeing with the market? And I think it's sort of these big trends that Greg Jensen's talking about here. And so he's, in terms of that big core risks, he talked in the interview, I'm sharing the key clip here, where he said the biggest arbitrage you can sort of take in the world right now is take what the policymakers are giving you. They're giving you incredibly low interest rates relative to nominal GDP. And so if you can hedge that, if you can essentially take in cash flows that will move something like nominal GDP, like these cash cows, like Procter & Gamble, like Johnson & Johnson, Coca-Cola, these companies should move in step. They should have pricing power. They should move with the general economy. So he's saying, if you can take those cash flows, get a yield from that, and move something like nominal GDP, so they're growing along with GDP, and then hedge the risk, being short treasuries or other instruments that allow you to hedge the main risk. First of all, talking about hedging treasuries, that really, got my mind thinking. Wait a second. He's not the first one to talk about that. I've also called out, Dr. Michael Burry, his portfolio and how he's increasingly short U.S. Treasuries via shorting TLT. And so I'm thinking, man, this is the general direction you're looking at, which is as the Fed pulls support, you will see higher interest rates. And the reason why, Greg Jensen, I talked about what are the two key risks and how does the market, what potentially drives stocks lower. He said one is you either have a market downturn or two, you have the Fed tightening. He's actually not that worried about the general cyclical downturn. He's not worried about a cycle downturn, a general, like a recession, what you could expect, because his view is, look, the Federal Reserve is itching to be as aggressive as possible. You have incredible fiscal stimulus, so it's not like they're looking to pull the punch bowl. They're eager to do it. So his view is, if you have a traditional tightening by the economy pulling back, just effectively things slowing down, that is actually a sort of like a reasonable scenario for risk on assets, because then the Fed will be like, oh, we got to keep policy loose. And so, like, the perspective of the Delta variant, for example, if that leads to a worsening economy, then in theory, bad news is good news, where you have more stimulus and you have more Federal Reserve, incredibly aggressive, radical policies. So his view isn't actually that you have a cyclical downturn. His concern is that you have these negative consequences like inflation, like bubbles, like currency devaluation, and you get enough pressure there that forces the Fed to tighten faster than investors expect. And that's exactly what he talks about here, where the main risk is that the Fed has to tighten faster than people expect. The liquidity that has supported asset markets and created bubbles will have to be withdrawn. The assets that require constant liquidity infusion because they're not profitable, that's where we'd be nervous. And this is a key point. This is exactly part of what I think is the key liquidity trends that are driving growth stocks to sort of have a meh return this year, versus you still look at the S&P still marching ahead step by step. And it's because you have the consumer staples saying, hey, folks are willing to buy that. Now they recognize it might go down. Those consumer staples might go down, but they're going to hedge it. They're going to offset that long portfolio of these consumer staples. They're going to hedge it with a super short bet on treasuries. That's the key point, and that's a similarity to what you're seeing with Michael Burry. Effectively saying we could, and this was his prior point, is that hedge being short treasuries or other instruments that allow you to hedge the main risk of the Fed having to tighten. So you own cash flowing assets, own companies with a lot of free cash flow. So you have, let's say, a shareholder yield 2, 3, 4, 5%, versus treasuries sub 2%. So if they start going, if rates start going higher and bonds start dropping in price, you're hedged. You're hedging that core risk. And that means they must have huge short positions effectively against U.S. Treasuries, or really leveraged positions against Treasuries, which is really interesting to consider, because that's once again, you're seeing several smart, intelligent investors considering this. And so I think these unprofitable growth companies, they're coming under pressure because, yeah, they might be growing significantly, but because the business model isn't profitable now and likely won't be profitable for the next few years, it's sort of saying, well, wait a second, as the Fed removes support, these companies might need to go into the markets in the future, and there's going to be less acceptance for companies that are unprofitable versus the companies that have this big cash cows, the consumer staples that can raise prices and then just minting profits, that have sort of a valuation backstop. So the question is, so what am I personally doing? If you're interested, go to unrivaledinvesting.com, where I detail first week of the month my full portfolio. Last week of the month I have a potential multi-bagger. Then we also have an exclusive Discord community, interacting with the Unrivaled Nation on a daily basis. My personal view is a couple of things. One, looking for potential multi-baggers each month, trying to find a new idea where, regardless of the economic picture, there's a structural tailwind where this company could be significantly larger in the future. And so, for example, this month I'm calling it a company that's growing 200 to 300% this year and trades at 3 to 4 times sales. And so that's very reasonable, and it's profitable, by the way. So I'm looking at that type of setup. I also personally, looking at companies where it's like, even if you're not profitable, but you're a really strong growth company, do you have the cash on your balance sheet? So that way you could sustain, for years and years and years. Your cash burn relative to your cash position is very reasonable. So looking at pictures like that, saying, okay, you don't have to tap the capital markets. Then this is more idiosyncratic, part of my personal investment journey is that I also do consider a sort of a dynamic hedging approach, which I also talk about. That's more, day to day versus looking at these potential multi-baggers that I'd like to hold over many year period. That's what I'm looking for. If this video has been helpful for you, talking about Greg Jensen, what's going on with Bridgewater, their playbook, and how it potentially can impact your investments, understanding the broader market environment. If this has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up. Thanks so much for watching.